Welcome back to Mostly Growth, the number one podcast in product monetization. And CJ, I heard you have a favorite book.
I don't know if I have a favorite book, but I do love to go dumpster diving in SEC disclosures. Is that what you're referring to?
The deep dives into the disclosures, the S1s, anything that the SEC publishes, you are reading every word of it.
I think I'm like the SEC's number one consumer. You know how they have YouTube plaques, Kyle? I should get an SEC. Like you've officially read over 100,000 of these things.
Well, it should be like those token awards, like you've used 1 trillion tokens for
Yeah.
OpenAI. It's like you've read 1,000,000,000 words of disclosures.
I could be the first SEC influencer.
The first and last. All of this is important. Ultimately, right now, you're finding things that people are not disclosing.
Yeah, it's like the anti-find. I'm finding things that are no longer there. And the thing that I've been obsessed with tracking down is where did all of these high net dollar retention rates go?
Where did the 130% net retention go? The missing 130s. But maybe we start with a story. Can you share maybe the favorite example that you have?
So this was the canary in the coal mine for me. So Workday, I think we all know who they are. They're the largest HCM provider, so HR software. It's how you figure out how many people work for your company. And they've also expanded into financial modules, including an ERP, billing system, etc. This is like a pretty straightforward SaaS play. And they, for a very long time, had reported net dollar retention rate and their gross retention rate, which is essentially like how often are customers renewing on a dollar denominated basis.
What was the historic net and gross retention rate of this business?
The gross is like almost never moved. It's always been 98%.
You either have to die or or you're gonna keep paying.
And then net dollar retention rate, like it was historically way above 120%.
Because they could sell you, like if you were on HCM, they could sell you the financial modules, or they could just raise price because you were locked in, or sell you maybe more user licenses, things like that.
You got it. They could sell you more licenses as you grow. And it was always done on like a per person basis. So if your company is growing, it's also going to go up with headcount growth over time. So the canary in the coal mine was last August. So about a year ago, the SEC sent Workday a letter and they read through their 10K. So each year you have to file this annual report. The 10Q is every quarter, 10K is once. And they noticed that something was off because Workday was referring to its net dollar retention rates in the MD&A. That's not a drug. It's management discussion and analysis.
It's a drug if you're CJ.
They weren't sharing the rates, Kyle. So the fine folks over at the SEC, they thought it might be something good to fix because like disclosures being like the whole point of doing an SEC filing. It's for the public good so you can be an informed investor.
So wait, so like they're basically like, we have very healthy net dollar retention rates, and the SEC's like, but what are they?
Yeah. And so they're like, dude, you got to like tell the people what it is if you're referring to it. And Workday actually wrote back. And what's cool about the SEC is you can find in print what the responses were if the SEC like says WTF. And so they said, upon further consideration and in light of our planned quantification of factors contributing to changes in subscription services revenue, we no longer intend to include disclosures related to net revenue retention rates in our SEC filings. Net, the SEC asked Workday to tell investors what their NDR was, and Workday says, nah, dog, I'm good. We'll give you the gross retention, which is roughly 98% and has always been 98%. We're going to call it a day after that.
They should really go in the newsletter writing this is some writing skills. Upon further consideration and in light of our planned quantification of factors. Like, what is this language? This is worse than ChatGPT writing.
But it did the trick because SEC was like, okay, I guess. And they're not the outlier. This pattern is pervasive across the entire software index.
Workday, it still has great sticky customers from a gross revenue retention standpoint, and they want to keep sharing that with investors. But they used to be great at expanding customers. Now we have no idea. They're just not sharing the data, which I guess if I knew that was an option, it's a lot I would tell people. You're making it seem like this is not just Workday. This is a broader pattern.
It's not. And so as companies rode that seat-based expansion that we experienced during COVID and everybody was hiring, they're buying software, 120% or basically 20% embedded annual growth from the customers you already had, that became pretty normal. And I think in a lot of ways, Kyle, we didn't appreciate what we had until it was gone. So I'm going to get to some of the companies that stopped reporting, but I want to play a quick game with you as to the highest NDRs that you remember seeing.
Let's go for it.
What do you think Snowflake's highest was?
Oh, they were crazy high when they went public. It was like 175, I feel like.
Wow, 177 in their S1.
Yes. I didn't cheat. That was just my memory. Did they go public in like 2021? I feel like that was when I peaked. That was when all of SaaS peaked, myself included.
I think I peaked then too. I look back on that time frame. Twilio, early 2020.
They were good, but they were not that good. Maybe 130.
139, so almost 140. Once again, like as a publicly traded company, Kyle, you're saying I have 39% growth in the bag. That's a ton of growth.
What about Domo? Where were they?
Domo was over 150, I think, but they came back down to earth hard. And they're actually one of the folks that stopped reporting it.
These were some pretty high numbers that at the time just seemed like SaaS is a really great business model. Then seed expansion slowed down in dramatic fashion. What are some other examples here that had really, really high expansion?
GitLab IPO'd at 152%.
Although I think some of that was their price increases. They had like a massive price increase just before the IPO, but they staged it so that customers would have a stair step up in price like each year for 4 years.
And then my favorite one, just for their consistency, Datadog spent 14 straight quarters claiming, quote, above 130% in their 10Q.
That's a pretty impressive batting average.
And notice what I said there. I said above 130%. So that's not a specific number. And it's something we're going to get into in a little bit because there are different flavors of how you either disclose or don't disclose.
People assume there's a formula for it. Like if you were to Google how to calculate net dollar retention, you could get really clear advice.
I better come up, by the way, when you type that in. I've done way too much work on it.
I think Nickelback will come up instead of you. But we should say, like, this has never been a consistent metric within public companies.
Oh, no, it's not a gap metric. You're not required to disclose it, but based on the business model and who your comps are, it looks pretty funny if you don't include something that everybody else does. I thought it was the GOAT metric of the early 2020s because if you were in a room with any late stage investor or crossover investor, after asking about your growth rate, the second question was never about profitability. It was always, what is your net dollar retention rate?
There were examples like Figma. They got a lot of slack for how they calculated their net retention rates.
There are funny ways to calculate it where you can change what the look back period is or the size of the customer that you're going to include. So there are some companies out there like Snowflake, and they've always been consistent, but their look back period is not 12 months, it's 24 months. And in a usage-based or commitment-based model, you obviously have more time to ramp in 2 years versus 1 year, but at least they're only measuring the customers who were on board at that period 2 years ago. There are other companies that have played it fast and loose by saying, oh, it's net dollar retention rate, but we don't include any customers, say, below $5,000. And it's like, well, aren't 90% of your customers below $5,000? Isn't this basically just a metric of like big deals happen to stick around because they can't pull you out?
Wasn't there one that was like, this is the net retention rate, but excluding churn?
It was pretty bogus. And then they came back out and said, this is actually what we meant by it.
VCs will actually calculate this for every company so that there's consistency. But in the public market sense, like you're kind of doing some storytelling around this metric. Like this was never really a consistent gap metric. This was a way that companies could convince their investors that they were, building a healthy business.
Yeah, and the biggest crime that I've seen and actually committed myself, unknowingly at first at least, is using CAR. So you're using the expansion of whatever the exit deal value is. So say it's a 3-year deal that ramps at 100 to 200 to 300,000 in the third year, including that 300,000 as the actual expansion when you actually haven't billed or received that revenue or provided services for it. I'm saying that these companies should continue to give this metric, but I just want people to understand that it's never really been captured consistently, like in the vernacular.
Yeah. So basically discounting even the first year, you're kind of like baking in expansion when it's really just having a discount in year one.
Exactly.
Hey, thanks for listening. We'll be right back after a word from our sponsors.
When I looked to set up my first CRM at Growth Unhinged, I knew I wanted something that was actually AI first. The world has evolved. Most CRMs are still stuck in the 90s. I found Lightfield, the CRM that remembers everything and does the work for you. It joins all my sales calls, reads my emails, and has the full context on every account. At this point, Lightfield knows my deals better than I do. I haven't had to set up a single CRM dashboard. Instead, I simply ask Lightfield questions like, which deals in my pipeline are most likely to close, or who do I need to follow up with today? It even automatically prepares me for meetings with a personalized daily briefing, and setup was quick and surprisingly painless. Lightfield is my sales coach, RevOps analyst, therapist, EA, all in one. See Lightfield for yourself with a 14-day free trial. Connecting data from your inbox takes just 5 minutes, and you can migrate in under an hour. Go to lightfield.app, that's lightfield.app, and use code MOSTLYGROWTH to get 3 months free. When I went all in on my newsletter, Growth Unhinged, last year, I quickly decided it was time to make the switch to beehiiv. I chose beehiiv because they're serious about powering the internet's best newsletters. beehiiv's all-in-one platform brings together newsletters, websites, and every tool you need to grow and earn. And they keep making it better. You can now launch, host, and monetize your podcast entirely on beehiiv. You can host webinars on beehiiv. And you can access beehiiv through the new MCP. I just use beehiiv's MCP in Claude Cowork to audit my site, prioritize SEO fixes, and analyze subscriber trends. It's my newest obsession. If you care about owning your audience, beehiiv is a no-brainer. Try beehiiv for free by going to beehiiv.com. That's beehiiv.com. Use Kyle30 for 30% off your first 3 months.
Ali and the team at Tabs are building something that directly addresses one of the biggest headaches I see finance teams deal with today. Pulling data from your ERP, your CRM, your FP&A tools, and your usage systems, and actually making it all work together. If you're running usage-based pricing or complex contracts, you already know how this usually plays out. Contracts live in one system, usage data lives somewhere else, billing happens in another tool. RevRec gets layered on top at month end, and finance ends up just reconciling everything by hand to close the books. This is exactly the problem Tabs was built to solve. Tabs is an AI-native revenue platform built for controllers and CFOs. It brings together data from your ERP, CRM, and real product usage into a single system of record. From there, it automates billing, collections, and revenue recognition without finance having to duct tape workflows together every month. If usage-based revenue is core to your business, this is the future of how billing and RevRec get done. Go check them out at tabs.com/run. That's tabs.com/run.
But we should say, at least companies before were sharing this because this was a metric they were proud of. Companies don't seem to be as proud of their net retention rates anymore, huh?
So the first flavor of this is just announcing that you're done with it. So Fastly did this in their Q1 2024 10Q. So Kyle, I went back with my friend Claude. I had to actually upgrade my plan. I went through 82 different software companies and their quarterly disclosures, so 4 per year over the last 5 years, and compared. I flagged Fastly on this one. They just said, we're done with this. We're just not going to include it anymore. And they did it at a time when their net dollar retention wasn't free fall.
They were probably one of the first that was just like, we're just going to stop reporting on this.
Yeah, like conveniently didn't make sense for them anymore after it had dropped more than 30 points.
So Fastly started playing fast and loose. Who came next?
CrowdStrike. They're a perfect example. So from their IPO in 2019 through April of 2023, every single 10Q contained the phrase above 120%. So keep that in your head, above 120%. So you know it's at least 120, could be 123, could be 128, could be 150. But starting in July of 2023, the language suddenly changed to, quote, consistent with our expectations. And then it changed to in line with our expectations.
You know how many lawyers probably reviewed that?
Do you know how many dollars of attorney fees were paid to make that packet of words?
Does consistent with our expectations mean above 120%? Probably not. It probably means their expectations lowered, but then they came in at the lower expectation.
I call this flavor of moving to a premonition. We had a premonition that this would be a shitty quarter, and therefore it's in line with the shittiness that we expected.
This is like when you ask a psychic something, you look at your horoscope and it's like something that everyone can be like, yeah, that's probably true.
The fourth flavor is changing the cadence. So you don't have to just stop disclosing. You just stop doing it every quarter. And so Doximity reports net revenue retention once a year now. They do it once a year on March 31st. If you're an investor in FY 2022, you're like, this is amazing. This company has 157% net dollar retention rate. They just report every quarter. So now you got to wait a year. They come back later and they're like, hey, folks, it's 117. You're like, dude, you dropped 40% in 12 months.
Did they give an explanation for that? Or they're just like, it's still good?
Encino did the same party trick. They went from 148% in FY 23 to 117% in FY 24. So they plummeted by 31%. So it fluctuates too much. We don't want you to get confused. Like, they can play it off like, oh, it's going to cause so much noise. You're going to misunderstand the business. But then they just drive it straight off a cliff when they report it 12 months later.
So everyone was really proud about this metric and bragging about it when they had 130% plus net retention at its peak. So you looked at 82 companies. How many companies had 130% plus retention?
Your boy created a graphic to share here.
I report a y-axis crime mostly because of the decimals.
Stop it with your questions.
All right. So yeah, how many companies at its peak were in the 130 club?
16 companies out of the plus 80 I mentioned were claiming NDR of over 130. Like, if you were in the top quartiles, like, you do over 130%. And the same thing, like, the peak was at Q4 of 21 and Q1 of 2022. And you remember how the vibe shifted in Q1 of 2022, right?
Things change very quickly. All right. So it peaked at 16. How many are in the 130 club today?
Went down sequentially, went 11 to 10 to 10 to 5 to 3 to 2, back up to 4, then down to 1. And then we went 6 straight quarters at 0 companies out there reporting net dollar retention of over 130% until Q3 of 2025. Palantir is riding this AI story, and they're like, hold my beer. We're the only company over 130.
I'm curious what this would look like if you looked at like the 120 club. Like, what is is there a threshold where, like, once they get below a certain number, they just stop reporting it?
I think it's once you're below 110% as a mid-market or SMB company, and once you're below 120 as an enterprise company. I rarely see the threshold used that's not 110, 120, or 130. And remember, the 130 threshold is it got thrown out. In Datadog, 14 quarters, like we said, above 130, they were using that threshold. Then it got moved down to 120. But there are some publicly traded companies. I think Toast says over 110.
What's the thought process around this threshold? Is it like, if you're above these numbers, it's a good metric, and once you're below that, you're kind of like below average and you just don't want to call attention to it?
Yeah, it's two things. The first thing is that it's understood by public investors and the sell side analysts that, like, hey, if you deal with SMBs and you're over 110%, check mark, you're good. But the second thing is they don't want to report 111 one quarter and then 110 the next and be like, that should be a reason for the stock price to move and it represented a degradation in the business. Or a better example would be if it fell from 115 to 110. They'd rather just say it's 110 or higher. Nothing has actually changed within the business. Maybe there's seasonality. It's hedging to say, yes, we're checking the box, but we don't want to give you a number that you're going to overreact to.
Of the 82, how many are still reporting any sort of net retention metric?
Yeah, to keep it simple, more than 1/4 of the companies originally in the data set 5 years ago have stopped reporting it entirely.
A lot of companies are no longer reporting net retention. Of the ones who are still doing it, what does their net retention look like? Where are we as an industry?
So we peaked at 124%, and that was in Q2 of 2021. Went down by a couple points, then re-peaked around 123, 124-ish in the start of 2022. And then since then, it's been a downward slide. And so the trough was 108% in Q4 of 2025. And today it's 110%. So from peak to trough, it's been 14 percentage points at the median.
It's going back up, or at least stabilized?
It is stabilized. It's not going back up. It's been constant for 3 straight quarters at 110.
This is just of the companies that are reporting it. The average of the ones reporting is probably higher than like the average of every company. But even still, like, basically this is indicating things have probably stabilized, but stabilized at a lot lower level than where they were in 2021.
And so the top quartile, like we said, 130-ish%, your top quartile, that has also come down 14 points. And what's fascinating is then the median came down 14 points and the bottom quartile came down 15 points. So it's kind of like you had this penthouse, right? where it was these companies at like 150%, totally blowing it out. That has been completely deleted. It's not there anymore. And then you take all the quartiles, everyone, Kyle, in this apartment building that I'm describing basically just shifted down one floor by 14 to 15%.
And is this because the companies are so big, it's like just hard to have that net retention at scale? Or do you think that it's because all of the expansion revenue is going to companies like OpenAI and Anthropic?
It's easier to have that expansion revenue at scale. You have more customers to potentially cross-sell and upsell. So this is the number one driver to what I believe is durable revenue growth that goes into a DCF model and gives you that premium valuation. I think they are cautious around what to report now, even if it isn't horrible yet, because they're like, well, what if OpenAI and Anthropic suddenly lean into where we play? Then it could get really bad, and then they're going to ask even more questions. Part of this is, yes, the median and all these quartiles slid by 14 to 15 points. But I think in the back of the heads of a lot of these big companies are also saying, let's preemptively make it vague and kind of fuzz it up a bit, because if it does truly go south, at least they're not going to ask for that point from last quarter.
If you were in the shoes of the CFOs of publicly traded companies, like, do you think it's better to just be transparent and, if the business has challenges, like you're upfront about it, but you also are like, we understand it, we've got a plan? Or is it better to just like keep it quiet, try to get people to focus on other metrics?
I was talking to Aurelian Nolf, the CFO of Navan, former VP of FP&A and IR at Lyft. And he was saying at Lyft, we went from like losing $1 billion a year to making $1 billion a year while I was there for 4 years. And there were some very tough quarters along the way. Providing more information allowed investors to underwrite that transition period and feel comfortable with it. And he said, if I didn't give them those data points, as horrible as it was in that moment on that call to actually have to give them and to explain why, that's why investors stuck with them over time and they came out the other side. You create a bigger problem for yourself by taking the short-term way out. If you do plan on being a public company in 5 years, you want to bring those investors along for the ride. I think the best thing to do is to provide more detail and to be very open about what your plan is to improve the number.
I tend to lean towards transparency too. My experience is more on the private company side, but I always would be way more interested in just getting the raw numbers, and as opposed to feeling like people were hiding something. Because as soon as someone stops reporting something, or it's like they were bragging about the metric one quarter, a couple of quarters later, the metric's nowhere to be found, you just don't feel as confident about the overall business and feel like people are just trying to string you along or tell you a story. They've added AI to their product. They have these AI credit models. They're talking a lot about how much AI consumption there is, but they're not doing the math of like translating that to net retention growth. And so either it's not showing up in terms of like net retention, and so they're not effectively monetizing AI yet, or they will, and so then they're going to report net retention again, but only once it's rebounded.
And that's what'll be interesting if the disclosures start to come back because the numbers are improving. You made the point earlier, Kyle, that the median is not the median if companies are dropping out. And so by my estimation, it's fallen by 14%. I think it's dropped by at least 18% at the median if you were to put many of those companies back.
What do you think is driving this drop? Gross retention is getting worse, so people are churning. It could mean less price expansions. If you were able to raise price 5-7% year after year, and now you have to fight for a flat renewal, for example, less cross-sell or upsell of selling more products to a customer. And then there's natural like seat or usage expansion that's kind of just organic as your customers are growing their business. Like if you were to think about what's driving this drop, how would you bucket those?
I would think about it two things because the gross numbers haven't fallen that much. Like ServiceNow still looks impeccable at 98% plus. Same with Workday. I think it's companies with the threat of AI are not able to raise prices as aggressively as they used to. They're calling it a win if they're able to renew at the same amount, which means no increase in net retention. And then I have a theory or a hypothesis that a lot of these companies that have added AI products have experienced success, but it's been a mix shift where they're not consuming as much of their old product as they were before. So they're staying above 100%, but it may be priced differently. It may have went from SaaS to hybrid or usage-based, and it's not showing up in the numbers as a clear win yet. So they're in this transition period.
Fin, formerly known as Intercom, they recently announced that Salesforce is planning to acquire them for like $3 billion, which is pretty awesome for them. But they built a couple hundred million ARR business on SaaS revenue. My guess is that that is falling quarter after quarter as they focus on AI. And they've said their AI business is north of 100 million. Then that kind of begs the question of like, when you do the math of, hey, your customers are spending less on SaaS and more on AI, it probably nets out to above 100 net retention if I had to guess. But like, it's not nearly as high of an expansion as you'd expect given all that AI spend. A lot of it's trading software for AI.
And think about how much cost you're adding to your model and how much free cash flow you're reinvesting into the infrastructure to provide this. And so it's definitely not as clean as of a story. Not many companies in the public markets, actually none of them, can point to, hey, it's north of 130% other than Palantir, and the investments we're making in AI are directly impacting our net dollar retention rate, which is our measure of customers sticking around, getting value from our product and expanding over time.
Because of how much people are spending on tokens and AI compute, like you'd expect net retention to be pretty good. It's just like that used to be all profits and now it's a pretty high cost basis. And so net retention is actually not that high and we have all these costs. It's a pretty tough combo.
There's a huge impact on valuation. And so I ran a couple different regressions. When I came back up for air, Kyle, what I figured out is basically every 10 percentage points in NDR, so say going from 110 to 120%, is worth approximately one turn of forward EV to NTM revenue multiples. So if you're trading at 5x and you can raise your NDR by 10 points, you can trade at 6x. So that's a huge difference in valuation if you're a company that's growing pretty quickly. And that ratio increases the faster your company is growing.
Let's take a business that is maybe doing 250 million in ARR. What would be their valuation like today? And then if they were to improve NDR, what would it look like?
So if you're 250 million in ARR, you're trading at 8x forward. So let's say you're a $2 billion business in terms of your valuation. If you improve your NDR by 10 percentage points or one turn of your multiple, you're going to re-rate from 8x to 9x forward. Now you're 2.25 billion. So you get 250 million of upside from that 10 points of NDR. And remember, you may actually be growing the exact same amount, but the investors are saying, we're willing to underwrite this to a loftier valuation because you're showing that you've de-risked the model by having these happy customers.
You kind of disagreed with this. You said that, as you're at scale, you have that base of customers. You do want to maybe focus on NDR and, spend a lot more on upselling and cross-selling that base. I just think a lot of the expansion that software companies have seen have been like, hey, we're going to start with a team and then maybe go to a department and then go to a company or maybe go to a division. A lot of the expansion happens within that first year as the company goes from trying a product to that full rollout. But once you got the full rollout, it just gets harder and harder to sell more stuff or to raise the ceiling on that account. Companies accelerated to full rollout during COVID as their customers were all kind of going through this digital transformation, but then it kind of like fully penetrated that base. And then it's gotten way harder to expand customers from there.
And I think that's also why you see a Salesforce acquiring an Intercom or the artistly formerly known as Intercom Fin, because you need more products to sell into these accounts. And so this is one avenue. And that's why I think big companies have it easier in some respects because they become platforms, not just point solutions. And that gives you another lever to pull other than just increasing the price on the existing single product you had or trying to sledgehammer them with more seats or more usage on that single product.
Who has done the best job at keeping NDR close to, the peak, and who's done the worst job?
This is going to be called the peak to trough Hall of Shame or trough of pain. Snowflake has fallen 53 points from the high to the low. Remember, they were over 170.
They're still north of 120. Pretty impressive. I mean, that makes them like one of the top 5 probably companies out there.
Unity's another one. They fell 48 points. Doximity, we covered 43. Twilio, 42. Asana, 40. I have to shout out Asana, Kyle. They have provided the most detail on their net dollar retention every single quarter, despite things not going well.
Well, it is good that they've been so transparent, but that speaks to the challenge of being like a horizontal SaaS application. And they're like a project management app, which assumes it's a platform for people that are doing work. I'm sure they're trying to transition to more of like this AI work platform, but just hard to drive seat expansion for software that's meant for people right now when there's so much energy around AI.
And a couple of weird shout outs here. These are companies who just like were never part of the party. You couldn't say they stopped disclosing it because they never did. Do you know that Salesforce has never disclosed a net dollar retention rate?
That would be so tricky to measure with that business. I mean, they have so many products and they've acquired like dozens of companies over the years.
Same thing. ServiceNow, they report a renewal rate of 98 or 99%, which is also gross. And then companies like Adobe, Oracle, Autodesk, Intuit, and like we said, Workday, that's the no NDR group. Like they do have legitimate reasons for sitting it out. Like try explaining Oracle when you have 157 things to sell.
Or Adobe having a consumer business and a B2B business.
To end it on a positive note here, shout out to GitLab, Blackline, Dynatrace, PagerDuty, Five9, Twilio, DocuSign, JFrog, Klaviyo, Braze, Monday, and SentinelOne and Asana for helping all of us NDR dorks stay in the loop.
Mostly Growth is a Mostly Media production. Executive produced by Ben Hillman. That's me. Additional production by Steve Sarasoli. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of CJ, Kyle, and Ben. Just some guys who love talking growth. Mostly. If you like this podcast, hit subscribe and give it 5 stars. It only takes like 2 seconds and our algorithm overlords love it. Drink water, call your mom, and have a good day.